ecosystem.
Okay, we are recording now. Everything that was said
Professionalism.
previously is not official.
Unofficial.
Thank God.
I actually find that when things aren't being recorded, the things I say are even more official.
Well, that's just to the detriment of those who aren't listening.
Yeah, that's true, I suppose. Oi, well, we can maybe give people a minute to stream in. Otherwise, any subject matter we want to hit first?
Just wanted to.
We can give an update on migration,
Hmm.
and then
Sure.
do the alpha show.
Sure. I also have some ideas I'd like to throw against the wall while we've got some community members here. So
That sounds fun.
Nice.
yeah, start with some ideas, Evie.
Excellent. Well, the update is that we have the base level deposit contract. We figured that out. Basically, I met up with Eidolon and Zokanai just before this, and Zokanai basically just wrote the whole contract in real time. I've never seen anything like it. It was amazing to watch. And yeah, it's next level. If you guys ever get a chance to watch Zokanai program, you should do it.
Is it using Vim?
He was using Vim, and I was like, "What is this? What is the screen that I'm looking at?" And he was just like putting in command line prompts, and just it was insane.
That's good.
But yeah, so at the very most basic level, we have a contract that will allow you to deposit oath and grain, and it will record your address and how much you deposit, and then off chain we can calculate what your allocation is. We have a Boolean option within the contract that allows you to select whether you would like to vest your allocation or not. Now, for a lot of people, you just want to deposit Oath and Grain, get your new tokens, and just remain liquid. But for those who have come this far and are willing, it would help us a lot to manage float and inflation. For those of you with the conviction that many of us have, there will be an option to vest your allocation over 12 months. You'll receive, instead of just receiving liquid tokens at the end, you'll receive an NFT with your tokens vesting. And I think what we'll do is the new token foundation that gets its own allocation will actually commit like rewards to those vesting positions. So if you're happy to vest for that year, you will get bonus. And if you don't want to do that, that's fine. You can remain liquid as you otherwise would.
Maybe for some context, because it's kind of like almost a surface level thing. Because I know a lot of us that have stuck around to this point have kind of super high conviction. But in the world of crypto market making, crypto market structures, whatever, traders, prop firms, etc., deal in absolutes, and absolutes are generally like what is liquid right now and what is not liquid right now. So really, the ask is, hey, if you're going to be sticking around for 12 plus months anyway, which I'm going to be doing it. I know a lot of team members and a lot of community members are probably going to be doing it, but literally just it's kind of like you're getting paid to essentially sign a note saying, yeah, I'm sticking around. And then when prop firms and whatever analyze the float of the new token, they'll make their decisions more aggressively, and that's how we kind of revise the ecosystem value upwards. So really just kind of like a vanity thing. And a lot of that is also like my tokens, for example, being able to kind of pull those out of the theoretical circulation, and some of the other people who've accumulated quite a bit and have really long time horizons. Because really the goal here is, we want to, for the first time in a long ass time, be able to initiate kind of discovery of the value of all this stuff we're doing. And to do that, we're working with literally like the biggest and the best prop firms and trading firms in the business. And we're kind of taking a lot of their advice in terms of, you know, how we handle the migration so that it's not just like a shit show. Because that's like our biggest fear. Sorry, I'm close to the mic. If you missed anything, happy to repeat.
You can turn up the user volume as well for people at home. You can right click on Beavis and turn up his volume
Oh wow.
for like your own setup. But yeah, and I guess the last piece to remember there is that if you don't want to do it, you don't have to do it. You don't have to turn on the vest. You can just remain liquid
Yeah.
and just migrate as you would otherwise.
And we can do both, right, UV?
Yeah.
Like
So
you can have-
the current contract is just a Boolean 1 or 0, but you can like just migrate in two different wallets, and you can do partial. You can stay liquid in one of them, or you can do a vest in the other one.
Okay, cool. That makes sense. Thanks, okay.
I mean, theoretically, we could build the architecture that lets you create multiple positions in one wallet, but it creates a lot of complexity. And in order to get this thing moving faster, if we prioritize tempo, the only compromise for you guys is that you just have to send your oath to another wallet if you want to have two positions.
Yeah, and I think something else to consider. Well, I'm not going to suggest this. I was going to suggest people deterministically create multi-sigs in case they need to turn over wallets.
Well, the kicker
but if
is
it's in
that
an NFT,
the vest will be in an NFT. Everything is going to be some form of liquid. It's just a matter of whether you can move tokens or you move the vest in an NFT.
Yeah, really, it's like you know, even if you move over with the vested option, really that's just us saying, hey, traders, hey, liquidity providers, we're not going to nuke your liquidity, which is like for them, like I mean, they aren't as passionate as we are. You know, they're here to make money. So giving them those assurances just, you know, makes them a lot more excited to work with us. So yeah, maybe if that covers that, or is there anything else you want to touch on, UV, before I talk a little bit about some of the ideas our advisors have been pitching us?
No, that's the main development, is that we have that first contract. You know, it needs some security reviews, but we have progress and we have momentum. So
cool.
Go ahead.
Yeah, so this is something I haven't even shared internally yet. I had a meeting with some advisors / investors who are getting pretty excited about the merger. And whenever people are excited, they love to have ideas, which I think is really good. And one of them kind of hit me, and I've been like scratching my chin, you know, in between meetings and whatnot, trying to think whether it's a good idea or not. So their suggestion, you know, Reliquary is awesome because it lets people be liquid. I think it's objectively like a better sort of position, a better way to align long term. But for the reasons that I just described earlier, the signal that it sends to traders and market makers and liquidity providers is, you know, hey, you're taking on way more risk because these people can, you know, nuke you at any moment. And of course, you know, that may not be 100% reasonable, but you know, when you're a risk manager, it doesn't matter if a risk is reasonable. It just needs to be there for you to kind of revise your strategy. So, excuse me. So, what this person described, and this is maybe like on the extreme end of the spectrum, but they described a world where all of these new chapter tokens, being kind of the most powerful form of yield delivered, gaining exposure is done in his suggested paradigm on an a la carte basis, wherein a user, let's say they have their NFT or whatever, a user would stake their NFT to receive that given token, or stake some of their new tokens in order to receive that specific chapter token, and like lock it over a period of time, or not really lock it, but keep it staked over a period of time such that if they would withdraw before the end of the term, they have to sacrifice some amount of new tokens, which are sent to people who haven't pulled out as like an incentive to keep people like in the mix and keep people going, which kind of like with Reliquary, for example, if it's still fully liquid and you can still fully withdraw, but you might sacrifice some yield, I feel like that might be like enough of a deterrent without totally like, disabling people. And then what you have as well is you have kind of this new layer of game theory where selection and dilution of a given chapter's incentive stream becomes a new way to kind of add value and distribute value, because the speculation market, the indexing, et cetera, will just add new layers of risk and reward adjustment. And I've been thinking about it since. I think like I try not to have super strong opinions about tokenomics, because at the end of the day, it's like I'm going to be here no matter what. Like but I know you are going to be the ones kind of benefiting from chapters, and really the trade-off is either a simpler experience through the one new token staking, infinite stream, versus making the decision. It's like the end result is a greater value of the new token, but perhaps a worse, or not a worse or a better experience, but a more diverse experience for stakers, and slightly more work in that they will need to select, either select or deposit it in an index. So let me know what you guys like. Maybe UV or Over or Charles. What are your thoughts on that?
That sounds pretty cool to me. I mean, I think it's a good idea to be able to choose which one you want to stake in, and you can pick the risk exposure that you would like, or the chapters that you believe in most. So I think it's good.
Yeah, I guess to add to that, what I found in trying to attract all these LPs, like for Ironclad and Aurelius, like on Mantle and for Aurelius, there aren't as many kind of whales within our target market on Mantle. So trying to get people to move over and deposit on Aurelius is a pain in the butt, and it's taking longer than on Mode, for example, where we know a ton of whales and they're already there, and they're much more willing to deposit. And when I think about like exposure selection, I figure the interests of any of us aren't always going to be the same. And if you can be better aligned with a specific network, like, hey, I want this specific token, I'm LPing on this L2, I'm doing awesome stuff over here, then it might just be more desirable, even if the net APR is lower, or even if like there's a risk of making the wrong choice. It's like, I made a high conviction bet on this chain. I want to double down on it, and I want to dilute everybody else betting on it. So that's kind of how I've been thinking about it. Any thoughts, Charles or UV?
I mean, I think it's always nice to create
yeah.
options. I'm of the opinion, like people who want more concentrated exposure, or who want to pick and choose their risk profiles or whatever, will certainly appreciate it. I personally do not want to do that. So if there's an option to stake and just get everything as like a true index, then that's me. But
Yeah.
yeah, I'm sure there'll be a lot of, especially like, more sophisticated players who want to pick and choose where they concentrate their exposure. It's definitely an attractive option.
Well, what do you think about
The,
this?
the
Go
thing
ahead,
is,
Charles.
quickly, like the more it's a bit harder to see when there's only a handful of chapters, but the more chapters that get added on, I'd say the more powerful that the value in that is. Was my initial thought, but anyways.
Yeah, totally. And we can make the terms kind of short,
Mm.
and maybe based on what you guys are saying, how interesting would it be to, and this is like another idea we've been tossing around. I think we talked about it last happy hour, but if we're trying to we have these 10%, the 10% of these tokens earmarked for stakers, and let's say 5% of those we distribute straight up as here is your reward over a certain period of time, and then 5% are staked in the chapter in perpetuity as here are some forever rewards. Maybe the long-term oriented people would stake in pool number 2 to get those rewards, whereas speculators might want to go to the other ones. And yeah, Jesset, that's kind of the first thing that comes to mind is, complexity. But at the same time, we're kind of battling, when we try to take the simple path, for example, with Ethos, hey, let's just do buybacks. Hey, let's just have liquid staking. Hey, let's do bonded oath. In finance, especially when you're talking about the biggest market being derivatives, it's these layers of complexity and this modulation of risk and reward is how you create value and how you extract value. And you look at Pendle, for example, an insanely complicated platform that, maybe doesn't make a ton of money, but they can get infinite TVL simply because their job is to just add complexity and add nuance to assets. And of course, there's a lot of analogs. And I think it's really just about how much is too much and how little is too little? What's the sweet spot? How can we maintain an adequate level of accessibility for, our addressable market, while on the other side, on the other end, being able to create these kind of granular tools that will increase value for everybody. And also, again, touching on how do we make the absolute float being how do we make it so the amount of tokens in circulation are appealing? Because when we keep things super simple, they end up a lot of times being too simple. And maybe for example, the takeaway is, a slashing mechanism for unstaking, where everything else is the same, and that's kind of the deterrent to withdrawal that traders and market makers would need to feel comfortable providing liquidity. That's kind of the trade-off space that we're operating within. Because we're trying to simple max, of course, but simple maxing comes with its own issues, if you know what I'm saying. But I will say our top priority is making the value proposition simple and the user experience super straightforward. I'm almost afraid that you guys will get bored. It'll be so simple, but probably not.
Yeah, I mean, on the new token side, their aim is to bore you guys. On the new token side, our aim is to make you bored, and then just keep you enthralled by the protocols that we deliver that bring value to new token.
Yeah. And I guess I'll tell you, the long-term vision for new token is a lot more than just boring staking. Like we are going to need this layer of abstraction over all these chapters. And we have an opportunity. I know we've always talked about, hey, the ultimate abstract DeFi experience. It's why we built Moon. A lot of people are really hungry for it. Like we're renegotiating the Optimism grant at the moment, and the top of their mind is like, how do we get people kind of treating all of the Optimism chains as one chain, just like we're doing with chapters. It's kind of funny, but interoperability is like $1 billion problem. But yeah, there is no perfect solution, and I think like the best thing we can do is keep iterating in public here. I think that one of the best ways, and like I said, this is the first time kind of sharing some of these ideas, is overextend and then pull back and try to retain like the best mechanics and elements of each new idea, which will generally start somewhat complicated. But yeah,
I'm curious why you go that direction rather than underextend and iterate on top of what's been like. What's the thought process there?
Well, because you
like-
can't see into the future if you're underextending. It's like
Yeah,
if you're like, hey, let's come up with the simplest thing ever, then it stops there. Whereas if you have like complexity kind of requires interrogation inherently. And if you start with a super simple solution, it's like the midwit meme. It's like you can't investigate the problem enough trying to solve for complexities to actually come up with a good simple solution. I think the kind of difference is maybe using the word simple is wrong. Maybe the word we're looking for is elegant. How can you get all the best properties of a given set of mechanisms or tools in the simplest form possible?
I think that a lot of the time I do this, and I think people mistake when you say complexity, meaning complexity on the user, on the UX level, which is not generally what you're talking about.
No,
yeah, I think
on the
elegance is a
mechanism
good like there isn't one. It's not, mechanism doesn't have to be proportional to the UX in terms of complexity. I mean, I guess that's obvious, but like not conflating the two or thinking that they're correlated is helpful. I like the word elegance. I think that's a good way to put it.
Yeah. And I agree with you, Silver Chronos. Like, I hate touching tokens. Every time I have like a tax event, like maybe 0.1% of me dies. So I just like holding on to stuff. I'm like, I don't want to say I'm a hoarder. It's not intentional, but it's like I just let stuff accumulate and don't worry about it too much. But yeah, I mean, that's all really great feedback. This advisor and I are meeting again next week to explore a little further, and I'll take all this feedback back to him. But yeah, what the heck is StatBot?
What the heck is StatBot?
Dude, what?
Dude, what the hell?
Cal, what the hell did you just do? That's awesome.
That's awesome. Dope. But yeah, I think
Yeah, the chart is going up. You should buy it.
Yeah, for real. I think we have explored that sufficiently. A lot of this stuff I'll take into general chat or the governor's telegram if you're there. If you're not there, comment and we'll share the link and discuss some of the options. But yeah, the staking experience is so crucial, like getting it right. The staking experience and the migration experience, such that, again, liquidity providers, market makers feel good about the distribution and the float of all these assets, because they're taking on the biggest risks, LPs. and we need to make sure as long-term holders that we're respecting that. And that's something we've done kind of a bad job of in the past. Is not really, I mean, by virtue of not understanding it, not respecting it sufficiently. So yeah, maybe moving on, Charles, to the new chapter.
Alpha.
Yeah, this is exciting.
Oh.
So, Oliver has been kind enough to join us on stage and talk about something he's been working on. And this, this is a bit of, the core community, hardcore, event attendees, alpha.
Yeah, some real alpha.
Yes, exactly. I did want to shout out on the topic of chapters and stuff. I wanted to shout out Ironclad for the moment, as it hit 110 mil market size, which is pretty awesome.
Yeah, really great.
Then really great to see. So, anyway, shout out to the Ironclad team. That's dope. Yeah. Okay. So, Oliver, how do you wanna do this? I can fire off some questions. I've got a couple images that I can kind of just show people as you talk. What do you think? What's the best?
Yeah, sure. I mean, you can ask some questions, or I guess I could explain the background of the chapter, but either way is fine.
Sure. I like the starting with the background as I prepare my screen here. But yeah.
Okay.
So yeah, how did it start, and what gave you this idea? And I don't know. Go for it. Start wherever you want.
Well, I guess the start is at the end of the bull market. I guess we all got wrecked very much, and it kind of got me thinking a lot. And there was also a lot of talk about real world assets. It has been like really hyped, and we all know that crypto is like a minuscule percentage of all the assets in the world. So real estate, bonds, and stocks are like the really big assets, and these are coming into crypto, and we know they will, and we've seen that development as well. There's a lot more real estate products, and especially bonds like treasury bill yield, and like for a while, the treasury bill yield was like higher than in DeFi, and if you can get that yield, then there isn't really any reason to use DeFi. So for a long time, everything was dead. And I guess now things are a bit different. The yields are pumping back up. Now we're going degen again. But the fact still remains there's like a big need for these real world assets. I think we need asset diversification. If you want to take some profits, for example, then like the option before was maybe you take your money out into your bank or something. But I think it would be great if we had real world assets as well, and then you could have it as like a sustainable source of yield. So that's kind of the background and the idea for this chapter. So it's based on real world assets, and we want to make them like more available, because that's a really big problem we've seen is that there's minimum buy limits and you have to KYC, and it's not really meant for most users. So we want to make it more available for people. And another problem is that there's not much you can do with these assets. Like they're not that fun, I guess. So we want to create like more use in DeFi for them. So we're building like a layer on top of real world assets that it's kind of like Ethos, I guess. It's using that's what we built on, and we refine Ethos even further to fit these real world assets. So you'll be able to take real world assets and use them as collateral. And then you'll still earn the underlying yield, but you could, for example, leverage so you could earn a lot higher yield. So that would be great, I think, because the treasury bill yield is like very safe, very stable, very reliable, and it's almost like it's boring, for a DeFi user. So maybe you're not, 5% yield or whatever is not enough. So I think a lot of people would like to be able to leverage it. And yeah, and you will also be able to hold the stable coin itself. And the stable coin, it will earn the part of the yield from these underlying assets. So it's kind of like an index asset for real world assets. So that way you can get exposure to a lot of different real world assets. And we kind of have like some bigger long-term visions as well. So I think this chapter has like a lot of potential. Like it can have hundreds of millions in TVL, and we're working with some really big partners for it. So I think it's gonna be really big, and
Hell
I guess
yeah.
we can go through some of these the brand, I guess, for our idea of the branding.
Yeah, I hope
So
everyone can see
yeah,
that. I might have jumped the gun a bit, but the name is Pluck. I hope I'm pronouncing that correctly.
yeah,
Actually, I haven't heard anyone say it yet. .fi. So a couple different um, branding images here. So okay, real world assets. What is the network? I think is the obvious next question, and why
mhm.
such network?
Yeah. We're gonna launch this on CK EVM, and we have like a really good connection with Polygon. So we've been working with them for a long time, and they want real world assets on their chain, and they've been a little bit slow to start. Like I think they have some technical problems, but I think CKVM has like really really big potential, and we also believe in the CK technology. So I think in the long term it's gonna be a really great bet, and we also have some great partners there that we're working with. So we have several that we'll launch with. And also we have grants by Polygon, so we'll be able to incentivize this if we have the need for that. And yeah, long term, we're also looking into how to improve KYC solutions, since with these types of assets, KYC could become quite a need. We won't need it like initially for the assets that we plan to launch, but in the future, we would like to be able to expand, and we want to be like a leader in KYC technology. So that's something that Polygon is also working on. So ideally, you'll be able to KYC in one place, and then you'll be KYC'd, across many different chains. And this will be possible with the technology that Polygon is building. And also, I think the CK tech stack that Polygon is building with, it's really like it's going to create like a network of chains that will share liquidity. So we will be able to access a lot of liquidity on this chain. So we think it's a really good place for this. I mean, we're not ruling it out that there could be other chains as well, and that kind of depends on the people that we're working with and the needs that we see. But it could be Ethereum, for example, because so far there's a lot of real-world assets there, and there's a lot of liquidity. But yeah, for now, we're doing this on CKM to start out with. So that's our launch plan.
Yeah, incredible. Can I ask? if you can give any information about this, might be too top secret even for the alpha, but collateral assets. Are there any collateral assets that you can talk about now? No
Yeah,
worries.
sure.
But yeah,
Yeah.
go ahead.
Yeah, we're the ones we're looking at to launch, depending on the Oracle situation. We're looking at USDM, which is a Mountain Protocol. They're a really good real-world asset provider. So they were number one for a long time. I think maybe they're still the number one in TVL, and it's basically a stable coin that has real-world asset as underlying yield. And they're a really great company, and they already have a big market share. So we're working with them, and also SDAI, like we've been working with Chronicle Labs and MakerDAO. And I mean, MakerDAO is obviously one of the the biggest DeFi companies, and they see the need for real-world assets, so the underlying yield for SDAI is from real-world assets. And we also have a good connection with Frax. So we're gonna have SFrax as well, and a large part of the yield there is also coming from real-world assets. So those are the ones we're looking to target on the launch.
Yeah, and maybe extending that a bit further. Silver has been doing a really great job of expanding our network into the RWA universe. If you watch Block Bites, you've probably seen him pull some people onto the podcast. But one of the most interesting partners that we've kind of come across is Securitize. And like he's saying, this probably won't be a day one partner because they're just setting up their infrastructure. But Securitize is making the BlackRock T-bill token. And what's special about this token is slowly becoming the backing of every other real world asset. So it's like what BlackRock has done is they've created a really liquid and powerful way to move T-bills on and off chain. And we're going to see Mountain, Ondo, and many more slowly replace their collateral backing with this BlackRock build token. And that's, that and the many more RWAs coming out of that camp is one of the things long term that we're most excited about. And I think, RWAs are just at the precipice of becoming adoptable. Like right now, if you've ever tried to engage with RWAs, like Oliver said, they're illiquid. Actually getting on the platforms is a big challenge. The KYC process is super lengthy if you're willing to even do it. So really what Pluck does is Pluck is as much a tool for you as it is for these companies to deliver their assets in a much more digestible and accessible package. And yeah, I'm extremely bullish on RWAs in the very long term, and Pluck is going to be a very long-term sort of operation. But maybe the most exciting part of it is it's going to represent the next upgrade of the Ethos Reserve system. So we're, if you've been messing around in Ethos Reserve, I'm sure you've experienced redemption. I'm sure you've experienced, the carry trade drawdown that comes with stable coins, where we're constantly trying to catch up to peg because we don't charge interest. Maybe over if you can kind of explain, and UV as well, what the strategy is for Pluck and our strategy on platforms beyond Pluck to support interest-bearing assets.
Yeah, go ahead, UV.
I have one quick point to interject. There was a question in the chat. I just want to highlight it before it gets lost. Wouldn't it be better for liquidity and growth purposes if all the products from the foundation use the same stable? That's a good question. And the response is that isolating the risk profiles between each of those protocols is much more attractive for large funds and investors. And it makes a lot more sense for the security of users and liquidity broadly, because if one protocol has an issue, it doesn't affect the entire network. But yes, back to this, Alva, I will let you take over.
Yeah, we pretty much designed like a new way to take interest, so we can take interest on the underlying yield. So SDAI, it's like 5% or something underlying yield now. And what we're doing with this is we're building like an interest rate controller that UV is working on, that it will be able to help peg the stablecoin, because big problem has been redemptions, and we don't want our users to get redeemed basically. So we want to create like a more powerful pegging mechanism. So what this will be able to do is, if we're below peg, for example, then the controller can read that, and it can increase the yield of the stablecoin by increasing how much interest we're taking from the underlying yield. And what that will do is it will drive demand into the stablecoin to farm this yield. So that should help bring the price back up. And then it can like dynamically control this. So we don't have to do anything. It's basically a system that dynamically adjusts on its own. And this is like something really new. I don't think anyone has done this so far with these kinds of systems. So it's really like a pretty big tech innovation that we're doing and that we'll be launching with this. So I'm pretty excited for it, and I think it will be like a really great feature. And it will, if we can, that's been a huge problem with these liquidity-based forks, is the peg is kind of unstable, or it's stable within the range basically. But that's not what we want. We want it stable at exactly $1, which will hopefully be easier with this. So I think it's a really cool feature, and I'm really looking forward to seeing it working.
Yeah, it's pretty hard to overstate, sorry, how like insane that is. Is literally a new DeFi primitive. So like massive props to UV and everyone working on the PID, the PID system. I've been PID pilled.
Oh, no.
Not. Sorry, PID.
PID.
PID,
but like, holy crap!
No.
RuneScape enjoyer.
We'll go back to
PID
dig
is
it.
is what we would call our latency when you're fighting someone in RuneScape back in the day. I think.
That's still what it is, and this can be PID.
That's like when people say
maybe
they dig it.
This might
Still
be
pondering how PRD distinguishes itself from Granary / Aave type interest curve, or even a Taro interest curve where the max APR percent is crazy high. Go off on this one, please, UV.
Yeah. Okay. So in the Granary / Aave type interest curve, you have this. It's a direct relationship between utilization and the interest rate. So if they set their optimal utilization to be, let's say it's 50%, and they choose the interest rate to be 5% at 50% utilization, the curve will go from 0, where there's no interest for 0 utilization. It'll go on a straight line up to 5% at 50% utilization. And then it goes up to, let's say, maybe 100% at 100% utilization. So there's these two straight lines that are connected at the 50%, right? So that's what we call the kink. Now, the kicker here is that Aave would love for the market to maintain 50% utilization at 5% interest rate. But if the market wants to borrow more and they're happy to accept a higher interest rate, then there's nothing that Aave can do about it. Right now, where you can earn like 40, 50, 60% yield on stablecoins, that translates to a utilization of like 70 or 80% on an asset that should be at 50% based on what they want. Just exactly Samson's point, just think about the Metis market of Granary, where there's a particular whale who is happy to accept interest rates of 100, 200%. So he's just max utilizing the stablecoin market on Metis. Now that's great if people want to supply assets to the market and earn yield. The reason why it's bad is that there's nothing that the protocol can do to make the supply side more liquid. We're basically in this stalemate where the whale is happy to pay 200% interest rates. The users who are supplying are getting close to 200% interest rates, but they're illiquid. They can't get their funds out because they're all borrowed. And people are generally afraid to supply more assets for the fear of also being illiquid, and this this fear of if something goes wrong, will there be bad debt, etc. The reason why the PID controller is superior to that model is that whatever you put as the base curve, if we pick the same thing as at 50% we want 5% and at 100% we want 100%, firstly, we don't need that kink anymore, so we can just have a smooth curve. But that's really only important in the early days. For example, when you first deploy the market and our special integrator term is still at 0, if somebody immediately deposits $1 million and just borrows everything, we need the interest rates to be high. But what happens is that whatever we set the optimum utilization at, the interest rate controller will refer to the utilization and it will reference the optimum utilization and it will adjust interest rates. So it doesn't matter what the market's appetite is. It doesn't matter how much the market wants to borrow. If it's above optimal, the controller will just continually increase interest rates until it's untenable for the market and they either pay back their loans or people supply more or whatever have you. So the end state is that the controller will forever correct the market conditions back to optimal utilization. And the advantage of that is that we can then increase optimal utilization without taking on the extra risk. And by constantly correcting the market back to optimal utilization, it means that we can generate more revenue because markets that aren't at optimal utilization will be enticed to come up to optimal utilization. So for example, in the Aave market, if optimal is 50% at 5% interest rates, but the market doesn't even want to pay 5% interest rates, you'll be stuck at maybe 30% utilization at 3% interest rate, which is maybe all the market wants. So with this system, because it's underutilized, the controller will decrease interest rates to bring it back up to optimal. So you'll get back to 50% utilization, but your interest rate will be 3%, which is what the market wants it to be. The difference being that you have that 50% utilization, which means the 3% interest that you're earning on a greater volume of borrows, if that makes sense. So you're getting 3% interest on 50% utilization instead of 3% interest on 30% utilization. So the point being that the market can pick what interest rate it wants. We will govern what the optimal utilization will be, and the controller will make everybody happy.
Yeah. And I would say DZFY, in many cases, this will result in less volatility and fewer liquidations. At least that's kind of my interpretation. Do you think that's accurate, UV?
Yeah, it's accurate because the way that Aave needs to mitigate these things is to just make that value at 100% utilization really, really high, which means that when someone comes in and just takes out a massive borrow, it just spikes interest rates like crazy. Now, to an extent, we our system will do that as well, but it only does it in the early days as like a defense mechanism for before the integrator component can actually accumulate. But because the integrated component requires time to accumulate, it means that when those big borrows and big repays happen, the interest rates won't be as volatile, because the tune dictates that the system requires some time in order to adjust. Now, we've learned from the Metis market where the curve, the maximum interest rate was 120%. It sat at 100% utilization for about a month before people got really antsy, and we had to deploy a new interest rate strategy, and we doubled the interest rate, and it allayed some fears, and it generated more revenue, etc. So we've kind of learned from that, and I've tuned the strategy that we have now to essentially achieve the same effect, where it aims to double the interest rate in about a month when utilization is at 100%. So if we deploy this strategy, firstly, we deploy it, we don't have to touch it. It doesn't matter what the market wants to do, we don't have to touch it. But if utilization gets to 100%, the interest rate will go to 120%. And then over a month of sustained maximum utilization, the interest rate will grow on its own to 240%. And that's like approximate values. So that should presumably push utilization back down to whatever we set the optimal to be, which in this particular strategy is 80%, which is generally what we aim for with stablecoins. And then the proportional error comes back down, and then the integrator stops accumulating, and so it should settle at whatever interest rate it settles at. And it'll basically, if it's above 80% utilization, it will grow the interest rate. And if it's below 80% utilization, it will shrink the interest rate. And it will just constantly correct back to 80% utilization.
Extremely cool.
That's the main distinguishing factor.
It's a continuously
it just,
dynamic system.
Yeah, it's like Aave's system right now. It's like here is one very dumb curve. Here's another very dumb curve, and here's a little system so that you hop from shallow curve to steep curve at that utilization rate. And the result is frankly a dumb system. And it's a dumb system that I think is good as far as dumb systems go. I think it being a dumb system is not necessarily a bad thing. But again, we're building for the future. We're building for the mid-market, and we're building for L2 networks and higher performance networks. So, it just kind of makes sense for us to have a more intelligent system. It's like we added a brain to the interest rate mechanism, basically. Yeah,
which, to call back to earlier, the problem is very complex, and the controller, like the theory of the controller is complex. The math is actually pretty simple, but the theory is complex, and the solution is very elegant. It's zero human input. Users don't have to do anything. The interest rate just adjusts itself.
And before we tie this back to Pluck again, which I would like to do in the context of Pluck, another scenario that I think maybe you might have mentioned but I missed was the curve situation that happened last year with Michael or Michel. But again, all the Aave v2 designed lending markets, he wasn't repaying because of the same situation that was happening on the Metis market. And then I also thought about maybe you could contrast the difference between the PID system and what Fraxlend does, because I think that's like a manual change that they have to make, but they decided to double their interest rate every 24 hours, and he repaid Fraxlend immediately, but they had to go in and actually change the system sort of manually or so it's the same situation, and it's a system that will take care of that itself. And if Michael is on lending platform, the PID system, then chances are he's going to repay that pretty quickly.
Yeah, and he would have repaid it much
Yeah.
sooner as well because he was at high utilization like a long time before the issue started.
Yeah.
It's
Um,
funny that like the status quo is waiting until something is wrong to react, and all of our research and all of our development is in, you know, figuring out how to find forward-looking indicators and create forward-looking mechanisms that are capable of reacting well before things become a problem. And I think that's when, you know, what sets our company apart is that like we're solving these insane existential problems, and really the only way we're able to do it is by virtue of being so large and so diverse in our skill sets. And you know, a lot of people when a company works on multiple projects, at least as openly as we do, there are a lot that do it not so openly, but they kind of think less of all of them. You're kind of revising the value of all of them downward. But the reality is, you know, DeFi is so difficult and so complex, and there are so many different problems that require different skill sets to solve. The fact that we're able to support a large enough organization to cover all that ground is why I think we're going to win. And you know, using chapters as kind of these bite-sized expressions of this tech and of our ability to iterate, I think is super cool. And I'm going to be working really hard to kind of change people's minds about this growth methodology. And it allows us to iterate way faster and do way cooler things and scope risk very tightly, which is awesome. So quick little aside there.
we have I acknowledge that we're on the hour here, but we have two very quick questions. Are there any other products you can see a PID in? The answer is yes. Realistically, anything where there's an input and an output that are directly correlated. If there's a direct influence, then we can develop a PID controller for it. You know, there's the base case of market utilization dictating interest rates. There's a case of stablecoin price dictating interest rates. There's
Skew and
potentially
funding
a case
rates,
of
even.
yeah. There's an even tighter case of stablecoin liquidity conditions dictating interest rates, which lets you front run price changes, which we are going to explore as well.
Imagine how easy our lives would get when a PID controller is controlling incentive distribution. I would maybe cry if we released that. Maybe even necessary considering how wide we're going. Maybe something to prioritize.
Yeah, there's infinite applications. The other question was how does Pluck integrate this again? So Pluck integrates it in that it has the ability to essentially charge an interest rate on the underlying collateral. So it can take a portion of the underlying collateral's yield, the collateral being interest bearing. So basically when the price of the stablecoin, if you take interest-bearing assets and you allow people to mint stablecoin, they're going to mint the stablecoin, buy more interest-bearing assets, and just loop it and just short the stablecoin to oblivion. So what we can do is when the price of the stablecoin drops, we can take yield from those interest-bearing assets and direct it to the stablecoin. So now the interest-bearing assets become stable and the stablecoin starts earning all of their yield. And we can manage that with a PID controller that tracks the stablecoin price and changes the rate that we charge on the interest-bearing assets. And all it has to do is protect the price. So if the price starts to go down, it will start charging interest on the interest-bearing assets. And if the price of the stablecoin stays down, it will start to grow the interest rate that it charges on the interest-bearing assets, and then it'll continue to adjust. So if the interest-bearing assets start to earn more without us knowing about it, or without us programming anything, or without us, essentially without us having to track it, if they just start earning more and people start to short the stablecoin more, the controller will just start charging more on the interest-bearing assets, and it will.
Yeah, and the punchline here is removing redemptions, which I think.
Yeah.
That's
That's
for
the really big
all
one.
the community. Yeah.
Yeah, the end state is that it should stop the stablecoin from going down in price, which means we should be able to alleviate the pain of redemptions.
Yeah. And yeah, the ideal state, and we can overstep this bound if we need to. We're going to be experimenting quite a bit with Pluck, but the ideal state is, if people are levering up on their RWAs and shorting the stablecoin, our ideal scenario is we will just take yield up to the amount being generated by the underlying asset. So, if you're levered up 10x on 4% APR, and the stablecoin is now 95 cents, for example, we will charge that entire capital base, which is levered up 10x, 4%, and essentially taking the yield from them, and thus we'll be able to earn really powerful returns, and stablecoin holders just eat good. And at scale, that's such a hugely powerful mechanism for alignment. And we want people to LP. We want people to use the stablecoin as kind of a function for utility and use it as collateral. We don't want people to just short it constantly. So that's what's going to let us support interest-bearing assets way, 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 way better. And the nice thing is, the way we built it, Ethos can adopt this, and so can Aurelius, which would mean no more debt ceilings on interest-bearing assets on either platform, and much fewer redemptions.
Nice. Charles, you want to close it out?
Yeah, sure. Yeah, maybe I'll try and whatever. How do I close this thing out? Thank you all for coming. I want to thank Oliver for hopping on stage and introducing Pluck. Super exciting. More official announcements. Well, unofficial announcements come. But yeah, this was a nice teaser for the community and for the alpha, and maybe we'll even withhold the recording until the official. Maybe I might get murdered by Null if I do that, but but yeah.
Honestly,
thank you all for
is
coming.
and getting people to watch a video is so difficult that
that's true. That's true. Yeah. Yeah, but thank you, Oliver, for coming on. Thanks, UV, for chatting PIDs again. And
yeah, thank you.
Oh, maybe okay, you know what? I'll save that for next time. But we have more.
Here we go.
All right, closing out. Okay, thanks everyone for coming. I hope you all have a wonderful weekend, and we'll see you in a couple weeks. Okay,
all right, see you.
Bye.
Bye.